Hi guys, I am Shane Galea, your leading property development expert for your property development needs. In today's My Development podcast, let's talk about what is a feasibility study, how to conduct one for your property development. In the last few years, the development and awareness of project management training have changed considerably, and these developments are projected to continue and spread. With the rise of project management, a feasibility study is becoming more important. What is a feasibility study? As the word implies, a feasibility analysis is used to establish the viability of a concept, such as establishing that a project is technically, legally, and economically feasible. It informs us if a project is worthwhile. In some situations, a project may be impossible to complete. There are several factors for this, including the need for too many resources, which not only stops those resources from accomplishing other duties but also may cost more than the company would recoup by taking on a project that isn't lucrative. A well-designed study should include a description of the product or service, details of operations and management, accounting statements, marketing research and policies, legal requirements, tax duties, and financial data, as well as previous phases of the project or business. Such investigations usually precede project implementation and technical development. What does a feasibility study entail? The outcomes of your property development project feasibility study are summarized in a feasibility report, which normally comprises the following sections: executive summary, description of product or service, technology considerations, product service marketplace, marketing strategy, organization staffing, schedule, financial projections, findings and recommendations. Types of a feasibility study. Because a feasibility analysis assesses a project's chances of success, projected objectivity is essential to the study's credibility with financial institutions and possible investors. There are 5 different types of feasibility studies, each examining a different topic, as stated below. Technical feasibility. The technical resources accessible to the organization are the subject of this examination. It aids companies in determining whether technical resources are adequate for the job and whether the technical team is capable of putting concepts into operational systems. The proposed system software, hardware, and other technical needs are also evaluated for technical viability. Economic feasibility. This evaluation usually includes a cost-benefit analysis of the project, which aids businesses in determining the project's viability, cost, and benefits before allocating financial resources. It also functions as an impartial project assessment and boosts project credibility by assisting decision-makers in determining the proposed project's positive economic advantages to the business. Legal feasibility. This assessment looks into if any proposed project component violates any regulations, such as zoning rules, social media legislation, or data privacy laws. Assume a company wishes to develop a new office building at a specified location. A feasibility study may discover that the desired location for the company is not designated for that sort of business. That organization has just saved a lot of time and effort by discovering that their idea was not feasible. Operational feasibility. This evaluation entails researching to evaluate whether, and to what extent, the organization's needs can be addressed by executing the task. Operational feasibility studies also look at how a project plan meets the requirements specified during the system development requirements analysis phase. Scheduling feasibility. This evaluation is essential for project success. After all, it will fail if a project is not completed on time. An organization predicts the time it will take to execute a project when scheduling feasibility. After all of these factors have been considered, the feasibility study can help identify any potential project constraints, such as internal corporate constraints, export, financial marketing, etc. Internal project constraints, budget, technical technology, resource, etc. External constraints, environment, logistics, laws and regulations, etc. Importance of feasibility study. The value of a feasibility study stems from the goal of an organization to get it right before investing resources, time, or money. A feasibility study may unearth fresh ideas that alter the scope of a project. It's preferable to make these decisions ahead of time rather than rushing into a project only to discover that it won't work. A feasibility study is usually advantageous to a project since it provides you and other stakeholders with a clear picture of what is being proposed. The following are some of the most significant benefits of doing a feasibility study. Improves the focus of project teams. Uncovers fresh possibilities. provides useful data for making a go and no-go judgment, limits the number of possible business ventures, identifies a compelling reason for pursuing the project. It improves the success rate by examining several parameters, assists in project decision-making, determines why it's not a good idea to go ahead. What are property development assessment and feasibility studies? You would not create a business without a business plan, would you? What would you do if you didn't know what marketing campaigns to run and when? How can you know if your price and sales projections are correct? How can you know the legal obligations you must meet? The same may be said for property development. A property development appraisal, often known as a feasibility study for real estate development, is similar to a business plan. It aids in the deconstruction of large projects and their execution in a controllable and timely manner with as few cost uncertainties as possible. Like a property development business plan, your property development appraisal and feasibility study will be essential in selecting the appropriate stakeholders on board with a business strategy. Their knowledge and support will be essential to your project, from bankers to builders and beyond. How to conduct a feasibility study for property development. Carry out a preliminary analysis. Start by mapping out your project strategy. You should concentrate on an unmet need, a market where demand exceeds supply, and if the property development plan or structure offers a distinct advantage. Then it would be best if you decided whether the feasibility factors are too high to overcome, i.e., unable to effectively market, too expensive, etc. Make a forecasted income statement. This stage necessitates going backward. Begin by estimating how much money the project will bring in, and then determine how much project funding is required to attain that goal. An income statement's premise is this: what services are necessary and how much will they cost, as well as any revenue changes, such as reimbursements, should all be considered. Conduct market research or market survey. Make your market analysis as complete as possible because this phase is essential to the success of your feasibility study. It's so crucial that if your company lacks the resources to perform one properly, it's better to engage an outside agency to do it for you. The market research will provide you with the most accurate depiction of the project's income and return on investment that you can expect. The geographic effects on the market, examining competitors, demography, the market's value and what your share will be, and whether the market is open to expansion are all factors to examine. Plan property development organization and operations. It's time to organize and run the proposed project to achieve its economic, technical, legal, and operational feasibility requirements. This isn't a one-dimensional, broad-brush project. It should cover startup expenditures, fixed capital, and ongoing expenses. Real estate, equipment, employees, merchandising tactics, supplier availability, overhead, and so on are all included in these expenditures. Make a balance sheet for the first day of operation. Create a list that contains things, sources, expenses, and available financing to accomplish this. This comprises calculating the assets and liabilities, which should be as precise as feasible. Leasing or acquiring land, buildings, and equipment and financing for assets and accounts payable are all liabilities to evaluate. Review and analyze all data. All of these processes are essential, but the evaluation and analysis are essential to guarantee that everything is in order and that nothing needs to be changed or tweaked. So, take a moment to review your work one final time. Analyze and evaluate your previous steps, such as the income statement, with your expenses and liabilities. Is it still possible? This is also a good opportunity to consider risk, analyze and manage it, and make any necessary contingency plan. Make a final decision. You've reached the point where you must decide whether the project is practical or not. That may appear straightforward, yet all of the preceding procedures have led up to this point. Before making that binary decision, consider whether the investment is worth the effort, time and energy, and money, and whether it is associated with the organization's objectives and long-term ambitions. What is involved in a feasibility study report for a property development? Property developers want to maximize the development's potential or put it to the best possible use. Put another way, they want to make the most money feasible from a development site. A good study aids the developer in achieving his objectives, whether they are to obtain a better understanding of the project, determine its viability, or raise additional finances. The cash flow is examined in a feasibility study. That is the sum of funds left after all expenditures have been paid, as well as equity, i.e., the developer's money after interest and loans have been paid. A preliminary property development feasibility study is typically conducted on a per unit, per lot basis with profits and expenses split up by every property. In your property development feasibility research, make sure to include the following: development property, facts about the proposed development, market research and analysis, total project development costs from start to end, complete financial analysis including sensitivity levels that accounts for interest rate, cost assumptions and/or sale price and vacancy fluctuations, a real estate valuation, a marketing strategy, a final recommendation. If you're filling out a loan application, you'll also need to include the following information: a compilation of financial records such as balance sheets, an overview of the real estate developer background, the different types of development costs involved in a feasibility study for a property development, costs of purchasing and acquiring land. All costs involved with purchasing the development asset are included in this estimate. For instance, stamp duty, land value, legal, such as lawyers' conveyancing fees, rates, and tax adjustments are. Finance cost. You can acquire a construction loan when you get your planning permission or development approval. It can be split into two parts. For instance, you may want to choose a development site first and then develop it later. In this case, you may first seek a retail loan to pay for the land. Finance costs include all recurring interest charges beginning with the first bank drawdown. Application expenses, legal fees, bank valuation fees, and establishment fees are all fees that become part of the financial charges. For arranging the loan, certain brokers may charge a raising fee. Professional fees. All fees charged by consultants and experts must be included in these fees. On every project, not all consultants and specialists are engaged. The cost of a professional depends on the scope of the project. Building designers, architects, hydraulic engineers, civil engineers, and structural engineers are just a few experts needed for property development. Council contributions. Councils charge several things. First, there are two types of expenses associated with residential property development: development approval or planning submission fees and building permit fees. Depending on what you're building, there may be expenses for land subdivision, strata title, and rezoning. A council contribution fee, often known as a development payment, is also charged by councils. These fees essentially compensate for the additional or new burden on the council's infrastructure. Utility connection fees. There is a charge when integrating utilities to a development site, such as power, water, stormwater, drainage, gas, and telecommunication. Construction costs are estimated based on the design or size of the townhome or dwelling you are constructing. Construction costs, for instance, might be estimated as per square meter or square rate. The standard rate is per square meter. 1 square equals 9.290304 square meters. When putting together a property development feasibility study, it's essential that these numbers are precise, as they can either kill a transaction or catch you off guard if you have the wrong fees. As a developer, you can determine building costs to a high degree of accuracy. To account for increases and decreases in labor and material costs, you should account for the total cost. The construction industry's published construction indexes can track the development process. This classification would include all project-related professional fees and expenses. Fees for planning and building licenses and expenses for power, gas, and water connections should all be incorporated. Marketing or selling costs. When an estate agent is employed to market and sell a home, their fees must be considered. A sales agent's compensation usually ranges from 1% to 2.75%. You should know that these commissions are legally authorized to be negotiated. Insurance. An essential expenditure that isn't usually appreciated. Due to the enormous number of persons involved in property development, it's essential to ensure that everyone participating in the project is covered by insurance, including consultants, specialists, your own company, builders, and subcontractors. When the structures are handed over, you will be responsible for insurance, including public liability and insurances against fire, storms, and other perils. Goods and Services Tax, GST. Business activity statements are often filed monthly when accounting for a property development project. This allows you to collect your input tax credits monthly, which helps to keep your income stream in check. However, after the project, you must pay GST on townhouses and developed property sales. Contingency. Developers, project managers are always confronted with cost overruns or hurdles, like with any other project. This is a proportion of building expenditures that a developer is willing to accept, usually between 5 and 10%. This proportion is intended to cover costs that you are unaware of. A classic example would be a delay in acquiring a building permit, which raises the cost of owning the property, or a tribunal hearing to address concerns. Thanks for listening to the My Development podcast, brought to you by Shane Galea, your property expert guide for your property needs.